Hey, Steve Saretsky here. As always, Canadian real estate market update with particular focus on Vancouver. If you get any sort of value or anything about these videos, I'll ask you to thumbs up and subscribe. Questions, comments, put those below. Lots to touch on this week. We've got some updated comments from Tiff Macklem with the Bank of Canada. We've got some updates from the banking regulator, OSFI, on the mortgage stress test. Some big movement in the bond market and some national housing figures, all of which we're going to get into this week. So stick around here. But, I got to start this week's video off with a funny headline as I was scrolling through Twitter the other day, which is, interest rates aren't working to fight inflation. And I'm going, I don't know about that. I mean, as one of the people that was early on the inflation call, I remember putting out videos in sort of, I think, late 2020 into early 2021 about the impacts that were going to manifest from all sort of the money printing that was going on, the excess stimulation, the spending, the central bank easing, the quantitative easing programs. Kind of, flagged all those, and I had a lot of pushback on that. But we got the inflation call right. I've been probably a little bit early on sort of the turn on inflation. I think certainly the war in Ukraine impacted that call, but nonetheless, I mean, you're not going to get every call right. That's not the point of this channel, but it's more along the discussions around it, which is all you had to do back in the day was look at the money creation that was happening, the credit growth, which is ultimately drives aggregate demand and then fuels inflationary forces. And so, there's a great chart here that was put out by my friend Brian Chang, basically highlighting Canada's M1 monetary growth, the base and basically monetary, the growth in money, essentially, in simple terms. And at what point it hit 28% during sort of the depths of the pandemic. So basically what it's saying is our monetary base grew by 28%. I mean, it's now rolling over, and you've now turned negative for the first time in a very, very long time. And so, if the monetary base is now contracting, again, this is a sort of a simplistic chart, but it really tells you all that you need to know, right? I mean, if people aren't taking out borrowing money to take out new mortgages and new lines of credit, there's no credit creation that's happening, which is a reduction in aggregate demand. So this is obviously what the central bank wants, right? Raise interest rates enough, choke off new credit being created into the economy, which is basically base money. And that basically is going to pull down aggregate demand. So I would argue, interest rates are working. Give them time. In fact, if you look at the 3-month annualized rate of inflation, it's now growing at 3.7%. I mean, that's down a lot. I mean, don't forget we peaked out around 7.5% here in Canada. So, the other sign that you can look for is clearly what's now happening again in the housing market. These things are all correlated. If housing prices are starting to drop, etc., there's again less money to be sort of borrowed against and spent into the real economy. So, we had our national housing figure data out this week, and more of the same, really. I think the big story here is that national house prices are now down 16%. So they dropped another 1.4% in the month of November on a month-over-month basis. So they're continuing to decline about 1.5% a month, and you're now down 16.4% since peaking earlier this year. Now, again, this index was created back in 2005 by the Canadian Real Estate Association. This is the steepest decline on record. The last single largest drawdown was in 2008, 2009, during the global financial crisis, when it dropped about 9% from peak. So we're at 16%, and because it's kind of a lagging indicator, it tells me that there is more downwards pressure to go. So this is by far not over. I mean, to suggest that you'll have a national house price correction peak to trough of 20%, I think is pretty much baked into the cake at this point. And then I think that, to get that 20% decline, you'd have to probably go back to the 1980s. If we start breaking this down, bit by bit, we can see that, again, certain markets are outperforming, or I should say are performing less bad. And this was always at least, something that I was kind of focused on, because, the sort of growth markets are in Vancouver, Toronto, and those are heavily geared towards interest rates remaining low because people are able to borrow so much money at these low interest rates, they can lever up, and thus you get your price growth. So, nationally, on a year-over-year basis, national house prices in Canada are down 4% on a year-over-year basis. Now, again, they've fallen 16% from the peak. But if you look at, year-over-year declines, Toronto leading the way, down 5.3%, Vancouver down 0.5%, Edmonton 0.6%, Ottawa 0.7%, Calgary up 9.7%. Again, this is, the right call, the bullish call in Calgary. Again, we certainly don't get them all right, and that's not what this channel is about. Now, don't get me wrong, Calgary, people that talk about it, it is rolling over. Price growth has peaked. It has come off from the peak, but it is still positive on a year to date. So when I say this is you could be looking at a situation where you have growth markets like Toronto suburbs, Vancouver suburbs, etc., that could drop of the magnitude of 20, 30, 35, maybe even 40% in some of these very small suburban markets that had huge growth. And you'll probably see, inner city Calgary, for example, might end up just going flat. It might just, and maybe it stays positive, but maybe it stays flat for 3-4 years. Meanwhile, you're picking up a higher rate of return on the yield, given the higher cap rates that are there. So in an environment where growth is likely to be subdued, at least that's the Bank of Canada's goal, I think you want to at least be picking up the coupon, which is the yield on the property. So that was kind of always the story behind Calgary, but I digress. If you look at these numbers and you say, well, man, they don't look too great, right? Down 16% on peak to trough basis. Well, the news didn't really get a whole lot better if you're speculating on real estate or if you're hoping for sort of that bounce back. In fact, OSFI, the banking regulator, updates their mortgage stress test on the December 15th every single year. So there was some speculation that maybe they'd ease the stress test. Mortgage rates are at 14-year highs. Why are we stress testing people? There's probably a decent probability that rates will come down. But in fact, OSFI has pushed back and says, nope, we're going to leave the stress test exactly how it is. They will be performing an additional review of underwriting standards in January, after which they'll probably provide another announcement, basically coming out and stating, hey, if economic conditions deteriorate faster than we expect, and we're always kind of ready to pivot. And I suspect that would be the case. Again, if you continue to get that drawn out, 16% peak to trough might be tolerable now. As you get to 20, 22, 23, I think regulators start to get antsy. So we'll be kind of keeping that. That's probably your story heading into 2023. But, some interesting comments here as well, from Tiff Macklem at the Bank of Canada. He was giving his monetary policy update, his year-end speech. So I thought there were some interesting comments from Tiff Macklem right here.
Last week, after the interest rate increase, you indicated that further changes to the level of interest rates would be data dependent. But at 4.25%, rates are firmly in restrictive territory. And I was wondering if you could speak to how long you see rates needing to be restrictive.
Well, as you highlighted, last week we raised by 50 basis points. We indicated that we would be considering whether interest rates needed to rise further. And yes, what does that mean? It means, going forward, our decisions about whether we need to raise rates further or whether it's time to pause are going to depend importantly on incoming data. We're going to get quite a bit of data before our next decision. And we'll really be looking at that through the lens of, what does that mean for the outlook for inflation? And as I mentioned in my remarks today, we're really trying to balance the risk on the one hand of we don't want to over-tighten. We don't want to put the economy through a more painful slowing than we need to. On the other hand, we don't want to under-tighten, because if we under-tighten, inflation's going to stay too high. Canadians are going to have to continue to endure the hardship of higher inflation. And ultimately, we're very likely to have to raise interest rates even further and have a sharper slowdown to get the economy, to get inflation back. So yes, we're trying to balance those. Of those two risks, the risk of not being sufficiently committed, not doing enough, given where inflation is now, given that inflation is well above our target, that looks like the bigger risk.
So as we talked about in last week's video, and some reiteration here from Tiff Macklem, that, you know, I think it looks like the pause is here. But the pause is not a pivot, right? I mean, the rate's at 4.25%, still restrictive, still painful for a highly levered household sector in Canada. So again, a pause does not mean a pivot. I think he's been pretty clear that they're going to try to hold rates for as long as possible at these levels. And I think the market is clearly sniffing out, right, the recession. I mean, Tiff Macklem and the Bank of Canada is even aware of that. They need to engineer lower to no growth in order to bring inflation down. And so the question is, like, you're going to have that recession. The question is more just how severe of the recession is it going to be? Now, if you look at the yield curve inversion, it's suggesting to me that low growth is going to be rather significant. And, you know, what's kind of interesting now is watching what's happening really in sort of the rates and the mortgage market, right? So the Bank of Canada will set your variable rate mortgage. You know, every time they raise interest rates, that floating rate variable, the prime rate will change. They don't control for example, they don't really control, you know, the bond market, which is, you know, let's say your 5-year Government of Canada bond yield. And so that's actually been coming down particularly hard. It's come off about 100 basis points in the last 6 to 7 weeks. Basically, as the market sort of prices in not only, you know, lower inflation starting to roll off, but also lower growth in the future. So the bond market is that's basically what the bond market is pricing, or what that signal is telling you today. Now, what's interestingly enough is that the Canada 5-year bond yield is basically at about 2.9% today. Those are levels that we last saw in May of this year. And if you go back and say, well, what were mortgage rates in May of this year? They were actually about in the low 4s. So the banks are still offering 5-year mortgages today in the low 5s. So there's about 100 basis point risk premium spread. Basically, the banks, I think, are pricing in that risk premium, maybe getting in a little bit greedy as well, saying, hey, look, these are going to be more difficult times. You know, mortgage originations are down about 30%. Why don't we take a larger profit on our originations here for new mortgages? And so they've been very reluctant to actually cut mortgage rates, when in fact, given where the cost of funding, which is predominantly indicative of where the Canada 5-year bond yield is, given that the cost of funding has actually been declining, they should be giving more off of these mortgage rates. Now, what's interestingly enough, some great anecdote insights here from Ron Butler, who's, you know, one of the largest independent brokers in Canada, one of the largest brokerage firms in Canada, noting that you can now get a CMHC insured 5-year mortgage at some of the non-bank lenders around the 4.5% range. So this is a substantial drop off. You're going to start to see the commercial banks. It basically takes one mover to sort of lead the charge, and the rest ultimately have to follow. But so the long answer, or the short answer, I should say, is if the Canada 5-year bond stays where it is, there's a lot of volatility in the bond market right now. It suggests that these 5-year rates, for example, should be moving lower in the very, very near future. So this is kind of a space I'm very fascinated in, because, you know, we've talked about there's not a whole lot of relief in sight for the housing market, given that the Bank of Canada maybe has paused, but they're going to leave rates here for at least a sustained period of time. OSFI hasn't come out and removed the stress test. So those are kind of out the window. But what you're looking at now and saying, well, I mean, at least the 5-year fixed rates probably hypothetically should be coming down into the 4s. I still think that's restrictive. That's not indicative of a bull market. That's not indicative that the market is going to bottom, but I think it certainly alleviates some of the pain point in that market. So that's kind of what I'm watching. I think heading into the new year, you guys know my personal view. Again, certainly don't get everything right. My personal view is that inflation is going to continue to roll over. I think that yields are going to continue to move lower as you get into that recession. And that's my view. And again, further down the road, do you get that double dip inflationary impulse, where you get the double peak, I should say, where, in the summer of 2024, we're talking about inflation roaring back and rates having to go back up again. I very much think that's a possibility at some point down the road, similar to what you kind of saw in the 80s, because I think inflation is certainly partially psychological as well. But I think in the near term, I think over the next sort of 3 to 6 months, I think that inflation continues to roll off as the economy heads into the dumps. So, as always, help that help. See you next week.